Thank you very much, Tim, and thanks everybody for joining, for having me. If we could skip to the agenda slide, please. So in my 10 minutes, I'll cover off a brief intro to SmartPay for those of you that might not be aware of who we are, what we do. We're actually a March year-end company, so our results were out at the end of May. So I've got a couple of slides just on our results, really not too much detail, but just really as a further intro into the sort of scale and scope of where we are today, and then I'll be happy to take questions. So if we jump over to the following slide, just in terms of an overview, what are we? So we're a merchant-facing in-store EFTPOS payments provider. We provide EFTPOS solutions to retailers, hospitality, on both sides of the ditch. We have a significant position in the New Zealand payments market. Our business came out of New Zealand. We're a large player in that market, and we have a smaller but rapidly growing business in Australia. In New Zealand, we're one of the leading providers. We own and operate a network of over 30,000 EFTPOS terminals in market. Those terminals, as I said, are retailers of every description, service providers, hotels, restaurants, etc. The revenue model in our New Zealand business is a predominantly fixed monthly revenue renter model. We rent our terminal and our software and our ancillary services. We charge a subscription fee, essentially a monthly subscription fee to our merchants. Our Australian business is our growth business. It was the second business to come on stream. Australia is really a growth market for us. It's a different business model to what we undertake in New Zealand. In New Zealand, as I said, it's a fixed fee for service model. Whereas in Australia, we clip the ticket. We perform what's called the acquiring service. In New Zealand, we just rent in hardware. In Australia, we provide essentially the banking service beyond the terminal. If you're a retailer and you have one of our terminals and you tap your card to buy a packet of chips, we attend to that transaction end to end. We attend to settlement back to the merchant, and for that we charge a clip of the transaction. It ranges typically between 1% and 2% of transaction value. Now in the Australian market, we're still very, very small. We're growing very quickly, but out of a total market of circa 1 million terminals, we're just under 5,000 at the moment. I'll show on a subsequent slide how we are growing. Perhaps if we can go to the next slide. So just to give you a snapshot of what the company looks like financially, these are results for the year ended 31 March. We achieved just over $28 million of revenue. That was a 34% increase on the prior year. That's predominantly been driven, in fact, exclusively been driven out of our Australian growth business, and I'll talk about that on the next slide in a moment. Our EBITDA again grew by 15% to 7.4 million. The business did generate a loss, and the loss widened, I should say, and I don't have time to cover a lot of financial detail here, but about $3 million of that loss was, well, $2.5 million is it's non-operational. We have a convertible note instrument as part of our funding structure. Because our share price went up so strongly over the period, we had to mark to market that and adjust that through our P&L. So $2.5 million of that is just a cost due to our share price increase. It's non-cash. We actually had some aborted deal costs. Those of you that have followed us in the past, we had reached agreement to sell our New Zealand business actually late last year for a significant amount of money, for $70 million. There were deal costs through that period. Unfortunately, COVID stopped that deal from happening for the moment, but that loss, there's a bit of analysis to really understand it. Our net debt, we've always had debt. We prudently use debt in the business. We've got 40,000 revenue units in market. It's well distributed, diverse cash flow. The banks like it. That being said, we did a capital raise recently, not to repay the debt, but really to accelerate our growth. But we did get some debt repayment through that. So our net debt at the moment is about $5 million. So very, very comfortable. Next slide, please. So just a little bit more on that results commentary. That 34% increase in revenue growth was driven largely out of our Australian business, our Australian acquiring revenues. When I refer to acquiring revenue, I'm talking about the click of the ticket that we share. So as I said, we charge 1 to 2% of the value that goes to the EFTPOS terminal. That grew to 9.5 million for the year, up 275% on the previous year's 2.5 million. Our monthly acquiring revenue, so the revenue from that line item, has grew through the period to from $500,000 a month is what we were earning through our Australian clip of the tickets. It grew to $1 million by the end of the year, so it doubled. That's pre-COVID. Obviously, we came back a bit during COVID, but we've more than come back again. We currently, I put an update out earlier this week, you guys can find on the stock exchange platforms. We're traveling at north of the $1 million again. So we've recovered from COVID and are growing. I'll skip the terminal fleet numbers. I'll get onto that on a subsequent slide. Our margin is growing as we continue to grow. Our business has operating leverage in it, and our product mix is tending towards a higher margin product for us, so that's good. We did do a capital raise in June, really to accelerate our growth. We were expecting a significant capital inflow, as I said, before from the sale of our New Zealand business. That didn't happen, so we raised capital instead to accelerate that growth. We're using that money to increase our marketing spend, and our sales generation is increasing accordingly. So at the moment, we're achieving record inbound lead generation, which will bode very well for our sales growth. Next slide, please. This slide is really the key slide. It tells the story of the growth in our Australian business. I focus on our Australian business because our New Zealand business is quite a mature, solid cash generating unit for us. We're a big player in a mature market, so there's not a hell of a lot of growth in New Zealand. It really underpins the growth into our Australian business. And that graph is plotting our number of terminals in market in Australia. On the left-hand side, you can see a strong growth since our journey began with our Australian acquiring product to about just shy of 5,000 terminals at the moment. We plot transacting terminals only, so that's why you see the dip on the blue line in sort of between February and April, May time. That's COVID, when terminals weren't transacting during lockdown. You can see it's started to come back nicely now as we've exited lockdown. On the right-hand side, we're plotting our revenue from that product in Australia. You can see a nice linear growth chart there as well. Comes off during COVID because, of course, people not using terminals. Shops closed. We live on the clip of the ticket that came back, but you can see the strong rebound again as we came out of lockdown and continue to grow. So as you can see, our monthly revenue approaching 1.2 million just from that part of the business on its own. I think that's probably a good 10-minute intro, and I'd be happy to take questions.
Thanks, Bradley. That was a quick presentation. Most appreciated.
Exactly 10 minutes by my watch.
We like it. We like it. So you said there's 1 million terminal. Well, if we go back a step, is the plan to sell the New Zealand business and then effectively kind of start again in Australia?
So look, we're not starting again in Australia. Our Australian business is established and growing quickly. The reality for us is we have a quality asset in New Zealand. It's good, high margin, defensible business, but it's not really a growth market for us. It's strategically quite a valuable asset in that market. We had an offer from our largest competitor to acquire that business for $70 million. To put that in context, we have had a significant re-rate since then on our stock, but at the time, our entire market cap was only $30 million. So we had an offer for more than double our market cap just for the mature part of our business. So we agreed to proceed on that basis. That deal came unstuck because actually we needed Commerce Commission approval, which is the New Zealand equivalent to the ACCC, because our competitor was looking to buy us. We knew we'd get the approval. It was just delayed, and it delayed to the point that allowed the other party to leave. They did two things. They terminated the sale on the one hand. They served us a sale termination notice because they could, because the length that process took. But on the other hand, they also served us with renegotiated deal terms. So essentially, they still want to do the deal. They were just looking for the COVID discount. Now, our New Zealand business, as I said, is not transactional. It's subscription-based, and it's shown itself to be hugely robust through COVID. So there was no reason for us to accept the discount. So we said no to that. Instead, we raised capital to continue our growth, particularly in Australia. Now, the question is, would we still sell that business? If they came back at full value, would we still sell it? We're not pressured to sell it for growth capital any longer. So we've solved that issue. The board will look at it at the time. The offer on the table was a significant offer. It would take us a while to earn that kind of money organically in that New Zealand business, but I can't speak with any certainty. I don't have a deal in hand at the moment. I can say that my personal belief is our business is as strategic an acquisition for that party and probably one or two others as ever. But through COVID, deals have stopped. So we'll wait and see what happens. In the meantime, we're proud owners of that business. It's a great margin business, and we'll continue to seek value there where we can.
Yeah, nice position to be in. Can I ask, so there's 1 million terminals in Australia, of which you've got 5,000. Who are the other competitors in this space for you? Is it?
Yeah, sure. So the incumbents, the legacy incumbents, are still the banks. Of the 1 million, between the banks and the large retailers, like Coles and Woolies, who do their own thing on terminals, that accounts for 95% of it. So that's what, 950,000 terminals, give or take. The remaining 5% is split largely between us and Tyro as independents. Tyro is about 10 times bigger than us. They've been at it for 15 years. They've got a good product. They'd be about, I don't know the exact numbers, but call it 45,000 terminals, give or take, in market is my sense. We're at about pushing up towards 5. So they're 10 times bigger than us, but we're growing very, very quickly. Both of us have a better product than the bank product. Functionally richer, does everything a bank product does, and then some. We also have some very innovative commercial products for our merchants, which is those two things are really driving our growth. A better functional and technically superior product than the incumbents, than the banks, and a better commercial model.
Yeah, there are a couple of questions around the value proposition compared to the banks and how you grab market share.
Sure. So every terminal in market will do what a bank terminal does, which is accept Visa, MasterCard, EFTPOS, and maybe Amex cards, right? Core functionality, every terminal does it. Every terminal has tap, insert, swipe. What is happening is that banks at the end of the day are financial services businesses. They're not technology businesses. Technology is evolving. So is merchant requirement in the payment part of their business. They want their payments provider to offer them more functionality. The bank product is stale and doesn't move. A bank terminal today is exactly the same as it was 30 years ago, except it has a color touchscreen with tap, but it still only accepts Visa, MasterCard, Amex predominantly, and EFTPOS. What we do is we have a technical capability where the banks don't have. Banks don't have any software engineers on their terminals. We have an in-house technical team that develops software for the terminal that uplifts the functionality. So some examples are our terminal does all those regular payment types. We also saw an opportunity to offer non-card payment types, particularly driven out of the Chinese payment schemes. In China, no one uses Visa or MasterCard. They use their mobile phones with WeChat or Alipay. It's QR code-based payments exchange. You scan a QR code and the money moves. We developed that for our terminal. We're the only terminal provider in market, I believe, that has all those regular Visa, MasterCard, EFTPOS, etc., but can also accept Alipay and WeChat on the terminal. It's just one example. It's relevant to the tourist market, to the education market, but it also future-proofs us should Visa or MasterCard or any other payment scheme come forward that isn't card-based. We can do it already. We also built a integration capability that allows our terminal to talk to anything in the cloud. It's an API framework. We use it, for example, to talk to both WeChat and Alipay. It's the same technology, but we talk to point of sale vendors. So these are the new generation of till systems. You wouldn't buy a physical Casio or Sharp till system if you're opening a restaurant or a retail store today. You don't even get software on your PC. It's run through, you have a till service called point of sale service that you subscribe to through the web. And it looks like you're running a till on your PC, but it could be anything, or it could be on your Mac or your iPhone. It's through a web session. We've built the technology to join that sales session, that web session in flight. We can enliven the terminal so that the merchant only has to key the sale transaction once into their point of sale. The terminal enlivens automatically. It accepts the transaction. It closes the loop. It provides speed. It provides less errors and fraud, and provides reporting to the merchant in a way they can't get from their bank. Another thing on that reporting, we have a real-time portal that allows merchants to log in and see all their transactions. If they're running a chain of restaurants or a fleet of vehicles, they can see all their transactions real-time by terminal, by site. Can't get that from a bank. You'd have to wait till the end of the month to get your banking statement, or log into your internet banking and you just see transaction. You can't make any sense of it. You can't do anything with it. So we offer the base facility with a whole lot of bells and whistles. Those are just some. There are others.
Yeah, well, And how does this different to, how is this different from Tyro, the other competitor you mentioned? We have a question.
So very similar to Tyro. Our product's very similar to Tyro product. We have some overlapping facilities, capabilities the banks don't have. For example, that integrated cloud integration to point of sale, they have the same capability. They stronger in certain verticals than us. For example, they developed a product for the medical space, medical fund rebating. We don't do, because between them and NAB through high caps, they're strong in that space. We as I said, we can accept Alipay and WeChat on the terminal. I believe they can only do one, not the other. We have a commercial offering that's also different to them at the banks, which is quite important. We have a simple flat rate product, whereas the banks is a cost plus product, which is very complicated for a merchant to understand, and variable, whereas ours is simple. We tell merchants looking at their business, you're a pharmacy in a certain postcode. We understand what your card mix and revenue profile will look like. So we'll quote them a fixed fee to accept Visa and MasterCard. Let's say, 1% or 1.2%, whatever it is in the case. Banks don't do that. They used to, they don't anymore. They've got a much more complicated pricing model. We also have, where we've seen a lot of growth and success, is a zero cost product, where we don't actually charge the merchant either a terminal rental or a clip of the ticket. It's a surcharge model. We put, say, 1.5% onto each transaction. So if you're a merchant, if you're a coffee shop and you have our zero cost product, someone buys a coffee for $4, it appears on the screen of the terminal at $4.06. That's the 1.5%. That's what the consumer pays. We sell $4 back to the merchant for selling the coffee. The 6 cents becomes our revenue line. Merchants seem to really like that system. It automates something that they could do manually, and some of them won't do manually. We do it in a regulatory compliant point of view. It makes our product very sticky, cost effective for the merchant, because some merchants are paying thousands of dollars a month in that clip to their bank. We remove that for them. It makes our product quite sticky, because once you already have the most technically proficient and feature-rich product, and it's at zero price to the merchants, a zero cost to the merchants, it's very hard for anyone to dislodge you. They can't beat you on functionality, and they can't offer a lower price. So that's where we've seen a lot of growth and a lot of success. So we're really able to, by being an end-to-end provider and controlling not only the technology provision and the hardware and the software, but also providing the commercial framework and managing the flow of funds and the settlement, we can innovate not only on the technology, but also on the commercial side to the merchant as well, through those kind of zero cost products.